Welcome to Quote Booster. In this episode, we're going to go over the amortization calculator. So, an amortized loan is a loan where you make an agreement with the lender to pay off that loan in a certain period of time. For a home loan, the most common period is 30 years and with a fixed interest rate for that period of time. So, they make an agreement to say, we're going to lend you this money for 30 years at this interest rate, and we're not going to change the term and we're not going to change the interest rate. And that's a pretty good deal. But I want to show you the only two ways that you can pay off that loan faster and to pay less interest to the bank, right? So there's only two ways that you can do it. The first way is the interest rate. So let's go over to the loan summary tab. The total interest on a $200,000 loan for 30 years at an 8% interest rate, which is a little bit high right now. The total interest is $328,000. But as soon as I drop this down, let's drop this down to half, right? So let's go to a 4% interest rate. We'll calculate it again. All of a sudden, the amount of interest that we pay for that loan is significantly less. We're at $143,000. If I drop this down even lower, 2%, this is like insanely low, right? So let's do the 2%, calculate that. Oh, for some reason it didn't load. Let me load that again. Here's the 2%, it goes down to 66,000. And essentially, if we went down to zero, you wouldn't be paying any interest on the loan, right? Like if somebody in theory was going to loan you that money for 30 years for zero amount, you would pay zero interest on it. So that's one of the primary methods, is to get the lowest interest rate possible, and you'll pay the least amount over time. And one of the things that Quote Booster does is when you sign up for our free service, we're going to watch mortgage rates and auto loan rates for you, and we'll notify you when rates drop below your current level rates. Why? Because that's one of the primary methods for you to save money. The other thing that you can do in order to save money is pay off the loan faster. So let's look at this. On the right side of the screen, I have the same loan. So both loans are $200,000. We're going to do a 4.5% interest rate. We could change this to any number. And then the term is going to change. So on the left side, we have a 30-year loan. And on the right side, we have a 15-year loan. If we go to the loan summary for how much total interest we'll pay, for the same amount of interest, we're paying a significant amount less. So $75,000 of total interest for the 15-year loan versus $164,000 for the 30-year loan. And the difference in between the same asset, so a $200,000 house, would be paying $364,000 for that asset or $275,000 for that asset. The loan press interest percentage is you're paying 138% over that loan amount, so that would be the asset price. Whereas for a 30-year loan with that interest, you're paying 182%. That loan and interest combined as a ratio to the loan amount. But let's go back to how this works. So one of the things you'll see is that if you pay off this loan faster, you're going to pay less interest toward this. But you're not prepaying any interest up front. So if we look at the first monthly payment, we see on your April payment for 2025, your mortgage payment is $1,014. For the 15-year loan, you're paying about $516 more. But the amount of interest you pay on it is $750 for your first month of interest for the $200,000 loan. And what do you think it's going to be for the 15-year? It's the exact same, $715. Oh, that was for me. So $750. So it's the same amount of interest. So whether you get a 15-year or a 30-year loan, it's the same amount. If we change this and go to 100 years and we calculate this, your loan summary, you're going to be paying a crazy amount of interest. And look, most of your payment is going to be interest up front, but it's $750. The only thing that does change, whether you do 100 years or a 50-year or a 30 or a 15, is that teeny slice of principal. So in the 100-year mortgage, you're only paying $8.50 toward the principal on the first month payment. But just like the 15 or the 30, you're paying $750 of interest. If you go to a year, so if we take a loan out for just a year, all of a sudden our loan amount, that first payment goes up astronomically. So it's $17,000 to pay off this $200,000 loan. But look, the interest, $750. Okay, so what does that mean? That means the second method for you to pay less interest on your loan is to pay it off quicker. If we take this same loan, so let me open up a new tab. If we take this same loan, so a $200,000 loan, a 4.5% rate, a 30-year term, but we start making extra payments. So we're going to add $518. So because of kind of penny rounding, we're going to set this to 518. Let's calculate what this would do. That's going to save us 15 years, right? So we're going to be able to pay off this 30-year loan as a 15-year mortgage if we pay 518, which is the exact same as paying a 15-year mortgage, right? So that 530. So those are the only two ways that if you have an amortized loan, that you can pay less interest on that loan. One is to pay it off sooner, so reduce the amount of time by making extra principal payments. Or the second is to go to the interest rates. And that's what Quote Booster helps out with. We help you understand these principles, and you can make the choices that kind of best fit your situation. But if you sign up for our free service, we'll alert you when interest rates drop so that you can kind of get the free money. That's like you're paying less for that interest and you'll pay off your loan quicker. So go to Quote Booster for all of your finance needs, and we'll help you out with this amortization table.